Welcome to episode, I think it's 87.
That was
Hey,
late.
I think it's 87. It's the Travis Kelsey episode
Okay.
of the podcast. So
Okay.
that's ripping off another podcast, the Pro.
Jury.
I'm Doug. There's Dave Damashek, does stuff for the NFL Network still. He would always say the jersey number of whichever podcast episode it was. Episode 9 would be what? I'm trying to think of who's a good number 9. Well, 18 would be Peyton Manning, something like that.
Roger Maris.
But it's a football podcast.
Joe Torre was number 9.
Yes, but it's a football podcast that we were talking about.
Sonny Jurgensen. Or was he?
Okay. I don't know.
He was upside down a lot. For now.
Touche. Anyway, here we are with the show, episode 80, blah, blah, blah. And I'm Doug. He's Jerry. We've got a few topics we want to talk about today. First, Jerry, let's do the one that's the most, if timely is the right word, or maybe it's not. Maybe that's the exact opposite of what we're going for. The question we want to ask is, as it relates to investing, do politics matter? And if so, to what degree? And if not, then we don't even have to address the if so. So, Jerry.
I'm going to throw out two major. So it's primary season has begun, right? In the election year that we're in.
Definitely.
So politics are on some people's minds. One major caveat, and I don't know that we can say that this is true any longer, but going on the assumption that all parties to the political on the political spectrum within the country anyway are on the same page with respect to free enterprise and the basic system that's been functioning in this country for its more or less its entire life.
You realize that's a very big assumption in this day and age.
Well, I know. See, I was trying not to get current per se.
Okay. All right.
And just go on the assumption.
Jerry's voting for Millard Fillmore the election.
I'd probably go for Calvin Coolidge, but that's okay. Assuming that that's the case, history has shown that it really hasn't mattered that much, at least not in the intermediate term. Certainly in the very short term, it can cause ups or downs depending on, who's perceived to be, maybe better for business, so to speak. But historically, it really hasn't mattered. I mean, I think that's an important point, because people oftentimes get caught up on, if so-and-so gets elected, I'm moving to, Nova Scotia or wherever, Botswana. And, it's one of those, if I had a dime every time I heard that, I wouldn't have to do this anymore. And it truly hasn't mattered in the sense of, like I said, the intermediate term, the ensuing next years. Do politics matter over the long haul? Well, certainly in the sense of what politics end up putting policies in place that are in the long-term well-being or to the long-term detriment of the economy and markets. So, and I mean, just looking at I guess my best evidence for why that doesn't matter is look at the long-term performance of the stock market. I mean, it's been more or less a 45-degree angle to the right with some serious crises along the way that make everybody think the world is ending. And then, of course, it doesn't, and then it moves on. So that's probably the best evidence for, and there have been myriad different political players in power at both local, state, and federal levels the last 200 and some odd years that the country's been in existence. And so I think the question, do politics matter? Yes, for sure, over time. And no doubt there, and I don't know if this isn't just politics that's arguing that things are different now. Isn't it every election is the most important election of our lifetime, right? And certainly there's things going on in the world today that I think are taking some people, taking them back with respect to, or giving them pause and rightfully so. I mean, there's no doubt. And we've talked a little bit about some of the cultural things that have gone on that we think are just in some ways, just not healthy. And we can do, that's more of a current political environment thing. But I think it is important to say that, regardless of who's in power, as long as I like to say, as long as we're still allowed to start a business relatively easily, which in this country we still are. There's places in the world where starting a business, the amount of red tape and bureaucracy that you have to go through just to start a business is so mind-boggling that people just give up. It's relatively easy. Now, is it easy to run a business? No, it's never easy to run a business. Is what's been going on more recently, and again, now I'm kind of veering into the current environment, has it made it more difficult to be in business? Yes, it has. Especially, small business is tougher than it's ever been. I think the landscape for small business is difficult. But I think generally speaking, over time, the political cycles, Democrat, Republican, left, right, they tend to kind of go back and forth and back and forth. But generally speaking, as long as we're allowed to be in business, the markets are generally, and the economy is generally a free enterprise economy, it's still going to continue to move forward. The warning signs that a lot of people have right now is there are things. There does seem to be this trend, and that is, allowing for more control by government. We've talked about this, and we think that's bad. Has it reached a point of critical mass where it does start, limiting your ability to have a business and all that kind of stuff? I don't think that's there yet. I suppose one could argue that it's kind of gone in a direction that's not favorable and makes you scratch your head a little bit, maybe even a lot. But the question, I think, was more geared towards, do politics matter? And historically, they really haven't, with respect to what investors can expect and what they have gotten over decades and decades and decades of history in the United States, and I would say in the Western world in general. Now, it's a topic that we could spend volumes and volumes and volumes discussing, but in this, as we kind of kick off a political year, I think it is important for folks, and we have to do this too, because we watch this every day. You got to keep things in perspective to some extent. I mean, things. I like to take the approach. Things are never as good or as bad.
Jerry, I've been telling you that for literally 2 years. That's the Connolly corollary.
Well, it's a good one. It's one of those few and rare times that Sorry.
Right. I personally think it's very important to check your impulses. Yes. Now, that doesn't mean that sometimes that your impulses aren't right, but try to take the opposite. Try to take the other guy's side of things and the long view, and it is helpful. I mean, this is not the first time we've been faced with weird situations or constitutional crises.
Not at all. I mean, you think of the Civil War. Brothers were killing each other. Is more often than not, the problem we have today with this 24/7 social media, news media, financial media world we live in is everything is sensationalized to a point of it's, the next Civil War, or we're in one, or there's an insurrection, or there's whatever. I mean, there have been weird stuff going on. There has been weird stuff going on over the last few years. COVID was a complete disaster that upended everything. Man-made, by the way, completely contrived. I'm convinced of it, and call me whatever you want, a conspiracy theorist or whatever. Eventually, when conspiracies start coming to reality, you start having to think twice about maybe those conspiracy nutcases that we all thought had tinfoil hats on, were maybe they weren't so far-fetched. And none of that's good. But again, some basics. We're still sitting here. We're still running our business. No one stormed the place and told us we have to shut down and go work, in a work camp or something. I mean, I know that sounds extreme and silly, but that's happened in history. It's happened within the last 100 years in places, and it's happening right now in the world. So we have it pretty good, and we have to keep that in perspective every now and then.
I do think a cause for concern, especially if you don't look not just at the Civil War, but the aftermath of the Civil War. It's a very real constitutional crisis that happened in that time. I was reading a book about Joshua Chamberlain, the hero of Gettysburg, or a hero of Gettysburg, if you.
Not easy.
Pardon?
Reconstruction was not
No,
easy.
it was not. It was not easy, and it was. You have a contested presidential election between Tilden and Hayes in there, very, very, very messy. You have an assassination of a president in the aftermath of the Civil War, and in the state of Maine, where Joshua Chamberlain was a politician, a political, and a militia leader, in a very ugly constitutional crisis where they had some delegates unseated, and things like this happened across. And this even happened to a greater degree in the South in the 20 years after the Civil War. I think the big difference is that even if there back then there was a common standard, I think the Judeo-Christian ethic that ran through society, even if sides did way miss the mark, we are increasingly having difficulty finding that common measuring stick that we can appeal to. I do, and that's a concern. That doesn't invalidate the fact that we need to have perspective and that we're still allowed to start our own businesses. But that is a trend that has me worried.
Yeah, I would say that there's people within, people that are now elected officials that frankly and plainly don't believe in our way of life, don't believe in are trying to, we all know who they are. We don't need to talk about them. And that is problematic. And I think that was allowed to happen. And I'm not even sure that the folks that were promoting it happening really understood what it was that they were unleashing, but they're finding out. And, still, I think it's enough of a minority that it can be beaten back, and I think may well be. The problem when that stuff starts to happen is even those that you might tend to agree with, as business people that just want to be left alone to run our business and sell to people who want to buy our products and services and what have you, can tend to. It's another form of complacency on one hand, but then on the other hand, somebody that you might agree with, but they're a little off their rocker enough that they start doing crazy stuff. And, that's when things can go off the rails. And so we have to, that's why I think perspective is important. We've got to, it's got to make sure that things don't go off the rails because everybody starts following someone down a path of insanity. And, they might sound like they might be right, but their tactics are insane. And let's just keep, we got to keep that from happening by keeping our perspective and focused on what really matters.
Sounds good. Bringing that segment to an end, we're going to switch gears again. I am going to provide some interstitial music by whistling a Toad the Wet Sprocket song as Walk on the Water. No. Jerry and I were talking about Big Head Todd and Toad the Wet Sprocket before, which really only have Todd and Toad in common, we think.
And an era.
Yes. I personally like some Big Head Todd. Not a super fan. But anyway, we're going to move on to the next segment today. We're going to talk about the role of taxes and investing. And I think I know what Jerry's going to say about this. He lit up when I suggested this. Absolutely lit up. So we are going to answer the age-old question, how to balance tax efficiency and investment returns, and not basically letting the tail wag the dog with regards to this kind of stuff.
Well, for one thing, I think we in the growth side of our investing, and typically speaking, we have two primary core strategies: a growth strategy and an income, or probably better term, dividend strategy. On the growth strategy side of it, really on all strategies, but it's most prevalent on the growth strategy because those tend to be companies that don't pay dividends. Your return comes from the growth and the value of the business. And because capital gains are treated still, not as much as they used to be, but still treated more, treated better from a taxation standpoint than actual income is. Dividend income, interest income, earned income. And states will vary, and certain tax brackets will make that more or less of an advantage for capital gains. But just by virtue of growth investing, you tend to be more tax efficient. Now that said, and prior to the last couple of years of underperformance in growth companies in our portfolio too, previously we had like 5 or 6 years of ridiculous outperformance, and a lot of transition that took place from companies that we owned for years and years and years and decades in some cases, had enormous capital gains, which we harvested to put into what we think might be the next 10 years, 15 years, 20 years of great companies. And during that period of time while they're growing, there's very little tax issues because you're just holding positions that you're expecting to be a part of their growth phase. But when you're making that transition, it can be painful because you do have capital gains taxes to pay. So you forget about the fact that it may be tax advantaged. It might be the first time in years and years that you had to pay any taxes on capital gains. And of course, we're talking about taxable accounts, not retirement accounts. But once you get past that, then what's the next level? Because a lot of people will want to, especially it happens at the end of the year. In a year, maybe they have gains that they took throughout the year, and they can, I want to take some losses to offset these gains. I can tell you that in almost 4 decades of doing this, most of the time when that's been done, it was a huge mistake, especially if it's at the end of the year and you're selling to wait. And the way the rules work is, if say you still like the company, but the beauty and the curse of public companies is that you can buy them easily and you can sell them easily, and you can buy them back easily, and you can sell them again easily, too easily in my opinion. But due to that, the rules are that you have to wait 31 days. Well, it's not necessarily due to that. The tax rules are, if you buy a position, you can't buy it back within 31 days. Otherwise, you end up with a wash sale. If in order to realize a loss, you can't buy it back within 31 days, or you create what's called a wash sale, and the loss will be disallowed. It will be as if you never sold it.
It will be kicked forward in time. You could take it at some point, but just not then.
No. If it's a realized loss and you never sell that position again, you will never get to use that loss. Yes, if it's still there in the future if you sell it and then never buy the company back again. But if you bought the company, sold it at a gain, or at a loss, and then did not wait the 31 days, that loss that you were trying to take goes away until you should sell it again. So it's not like you get to use it ever, unless you have to sell the company outright again.
You have to sell it again. You have to realize it.
So the point I'm making, though, is most people will come along at the end of the year saying, I've got these gains, I want to offset. And it's terrible timing because you're selling when everybody else is doing things like that. So normally what we want to do is say, okay, let's think about this throughout the course of the year. And rather than selling and waiting 31 days, now you might do that in a situation where maybe the stock has done really well. Odd that you would have a stock that's done really well and it's still at a loss, but who knows? Maybe it's something you bought at the previous peak. And it can happen. We've seen people, especially in these last 7 years or so, where 5 years ago when things were on our portfolio at the very top, and people came into great companies that were very highly valued at the time. Then they went way down. Now they've come back and done pretty darn well, but they still have a loss because they bought at a very high point. Well, that might be a time that you would say, all right, let's just sell it outright and wait 31 days because it has had a good run. Maybe it'll take the next 31 days and sell off. We can come back to it, or maybe it just won't go anywhere and we can buy it back at the same price. What you had to have happen is you sell it, wait 31 days to realize the loss, and then the darn thing goes up. Most of the time, especially because most loss harvesting is happening when the company is down in price. Unless there's something really wrong with the company, my experience over a long time has been when you're selling it to wait 31 days can be the worst possible and most expensive tax loss you've ever taken. I can't tell you how many times that we've seen companies where it's trading at 20, you paid 40 for it, it's down 50%, you sell it to take the loss. You wait 31 days and the darn thing's back to $35 a share or $32 a share. And what you just lost in value of the company was way more than what you would have paid in taxes, or way more than the benefit that you got from the taxes. What we prefer to do is find different times of the year to be strategic about it. And if we have a company that's down and at a loss and hopefully have cash available, what we like to do is double up on that position, because you can do that, wait 31 days, and sell the original share. So you can identify, I want to sell the shares that I bought in, 3 years ago at 30 or 40. Let me back up. We doubled the position. So you bought the shares at 40, however many years ago. Now it's at 20. Obviously this requires cash. Take that cash, buy twice the position, wait 31 days, and sell those original shares that you bought at 40. So you're now buying at 20. So your average price is down to 30. You sell the original shares in 31 days that you had bought at 40 and you book that loss. Let's say you sell, and I will tell you, well, I can't tell you how many times we've seen the loss disappear. Worse things could happen. Gee, I want to take a tax loss. Okay, well, let's double up the position. We'll wait 31 days to sell the original shares at a loss. Oops, it's not at a loss anymore. We've had that happen. And that's more common because especially if it's a company that's been hit, chances are it's in a position where it might rally. And when it rallies hard. And it doesn't tell you when it's going to do that. It doesn't ring a bell. And it can happen within those 31 days, especially if it's the end of the year. In fact, that's a great time to do it. So to do that strategy sometimes because everybody else is selling. And then they want to buy it back in 31 days, say in January. In fact, there's a term they call the January effect, which is often, you get the tax loss bounce, they call it, is the January effect, where people were selling in December to take the loss, but then they're buying back in January 31 days later and the darn thing rallies. Well, then I would rather be on the other side of that. And I'd be buying in December when everybody else is selling. And then I'm selling my lost position when there's strength. In fact, a really great scenario for that is you double the position at 20, maybe it rallies back to 30. So you still have a loss in the original shares, but you bought the new ones at 20 and now it's at 30. Well, all right, well, I'll sell the original shares that I bought at 40 and I got a $10 loss. I still get to book a loss. And by the way, you get to carry those losses over because you can only use $3,000 worth of capital losses in any year against earned income. So if you have more than $3,000 in capital losses in a given year that are realized, you can roll those losses forward to be used against future gains. And as an individual, I think corporations are limited in the time they can do that. It might be 5 years. Individuals can do that under current tax code indefinitely. So there's a tactic. Now that's a tactic for tax, efficient investing, if you will. But more important, and you probably would gather this from the way I would, the strategy, or I should say the tactic that I've described, we like to say in this shop, do not let the tax tail wag the investment dog. So make sure you're not making tax decisions that are contrary to an investment decision. So if the goal is just to realize tax losses, but you're making a really dumb move investment-wise, then don't do it. The investment decision should be made first. And
if you really don't want to pay any taxes, don't make any money. That's the best.
Yeah,
that's the
exactly
secret.
Right. That's exactly right.
Well, I think this is great advice for people who actually have tax losses. I've never ever had a loss on an investment, so I really don't know. Never. So I can't relate. But for the masses, for the chattel, yes, I think it's a great tactic
for the masses, not the few, the proud.
All right. So taxes, keep them in the back of your mind, but don't let them, again, the tax tail whack with the investment dog, as Jerry said. People do lose the forest, miss the forest. They fail to see the forest through the trees on that many times.
Yes.
And as for the January effect, I think the fact that everyone else is doing it is a good reason not to do it, vice versa. So
most often in investing, that's a pretty good thing.
And our final segment of this week, we are going to talk about something that we discussed last week as one of our 2 key qualities of a successful investment as defined by Jerry Frigon, who has some skins on the wall to back this up. But we talked about the quality of management at length yesterday. But today we're going to take up the other aspect of a successful investment, which is this idea of fertile fields of future growth. So I think of this as another way of looking at this. I view it as total addressable market. How big can the investment be? Jerry might define that differently, but that's how I look at it. That's a term we use both those terms very often in this shop by the research monkeys. So Jerry, future fields of fertile
growth. Somehow we got off on this fertile fields of future
growth.
It's actually just said fertile fields of growth.
I just like all the F's, but the problem is I get them twisted up. So
it's hard. Yeah, so this is obviously the most artistic part of the whole well-managed companies in front of fertile fields of growth. Keeping it simple and at a real 30,000 foot level, you started. What you suggested is really a good way of looking at it. Is determining what a business that has in front of it a market size that's significantly bigger than where it's at in its business right now. And that sounds really simple. It's not. It's obviously very hard. It may be a little bit easier in businesses where there is already a market. So, and let me step back and say, some of the best investments that we've ever made have been investments in companies where there wasn't necessarily a market for what it was doing yet. Okay. But we saw that there was an opportunity to be a gigantic market for what this company's product or service was about. And the difficulty on that is sometimes you're waiting, and sometimes waiting a long time for that market to come to fruition. But when it does, so the idea being, if you can find companies that are creating markets as opposed to participating in a market, or before they're participating in a market, it's a market that doesn't exist yet, but they see that there's a market there. And the classic example, I think, Steve Jobs was brilliant at this. If he would ask, not what's a problem to solve, but what's a product that somebody will want that they don't know they want yet. And then he was a master at that. And I think that's really getting to the heart of like some of the best investments that you can make if you figure that out. Problem is it's not realistic to think that you're going to find that every day, or you're going to find enough of those that you can, be adequately diversified. Now, no doubt. And as T. Rowe Price said, the great fortunes in the country have been made by men who held onto business positions through multiple market and economic cycles for decades and decades. And oftentimes those guys were owning just one company. It was their company, and that's how they became extraordinarily wealthy. But when you're talking about investing, where it's not you're not starting a company, you're not the company, you're investing. It's difficult to put a diversified portfolio together of companies that are all creating markets that don't exist yet. That's just it's not that common. So let's call it the next best thing is somebody that's involved in a market that is very large, where it already exists, or at some level the market exists, and they have a product or service that is just beginning to take market share. A good example for us would be in the early 2000s, we saw the opportunity in a company of what at the time was a small company called Salesforce.com, it started out as a client relationship management software in the cloud. At that point in time, people had no idea when you mentioned the cloud, they literally thought, it's like in the cloud. They didn't know what the cloud was. That's how early Salesforce was in the quote unquote cloud, let alone a business model that was software as a service, where it wasn't the old software model where it was make the software, buy a license, and then, you want to upgrade, you got to buy another license kind of thing. Software as a service is you basically are renting the software. Upgrades happen, you don't even know they're happening. And you're paying like a subscription that you're paying every month. Salesforce was brilliant at that business. And, when we bought Salesforce, maybe it was like a $3 to $4 billion market value company, which isn't small, but most of the world thought that Salesforce was a client relationship management software. And yes, they had this new cloud-based software as a service model. Okay, yeah. And it was displacing things like Goldmine and Act that were client relationship management software that you would download and put on your hard drive and all that kind of stuff. And everything resided on your hard drive. Clunky, had to buy upgrades. And, most people were thinking that's an interesting business, maybe even a good business. But what we felt Salesforce was really about was the overall enterprise database market, which was dominated at the time by a company called Oracle and another one, SAP. And that was like $125 billion, $100 to $125 billion addressable market right then and there in the early 2000s. And we envisioned Salesforce evolving into something that could take market share. So while it was doing, I think when we bought it, it was doing $200 or $300, $400 million in business revenue in a year. And at a $3 billion valuation, that was outrageously expensive. One of those which never traded at a value, quote unquote, by what the street would call a value. But if you saw that they were doing 300 million in sales in a market that was 125 billion in size, that they might, if they just got 10% of that market and got $12 billion and they're doing 200 or 300 million, I think we got something. So that's another way of looking at a fertile field of growth, is well managed. And we can have our issues with Mark Benioff on a lot of things, but he really was a great manager, especially in those early days, had a great vision. Fertile field of growth. I don't know. They were proving that a whole new frontier on a number of different fronts: cloud, software as a service, enterprise database, not just customer relationship management software. And the rest is history. Salesforce has gone on to be one of the most successful companies ever. And we ended up owning it for about 15, 17 years, something like that. So, there's a good, sometimes the best way to describe something is give an example.
When I think of this, I think of two different concepts. Those of you who might have heard of Tim Ferriss and the 4-Hour Work Week, he talked about this idea of effectiveness versus efficiency, where efficiency is how well you do something, but effectiveness is about how much what you do pushes the needle. And in that same way, if you have a great market share, but the total market isn't that great, it doesn't matter how much of a market share you have. Would you rather have a huge piece of a small pie or a small piece of a big pie, or even better, a big piece of a big pie?
We were just talking about a company today, will remain unnamed, but a great company. And, you don't get them all. I wish you bought it 15 years ago. It's like the Salesforce model. It's like somebody buying Salesforce today. All right. But the main story has been told. You get a company where they own, and Salesforce may even be a better example of still having some growth in it. But, this company literally owns the entire market that they're in. And so you start going, okay, well, how's this going to grow? From the standpoint of a growth company, it's so mature. It owns 100%, at least in the United States, it owns virtually 100% of the market. And so now their growth path is to go international, and that starts getting a lot harder, particularly in the business these guys are in. So that's a red flag for us when a company's already got the market. Sometimes people think, oh, it's dominant in the market. Well, okay, so it's got nowhere to go. Growth wise, it owns everything. It's not that it's a bad business. You'd hope they can start getting to where they're paying a dividend. And in this case, the company didn't do that. They were still seeing growth in front of them. That's a whole nother podcast sometime, talking about when a company gets to that mature growth stage and they're still trying to act like a growth company, when maybe what they should be is just a stable, good, solid, profitable business and returning shareholder money by dividend or whatever.
Something else I think of is it's so hard to find these unicorn type investments, because so much of what is done today and in terms of innovation is actually very iterative and just steps along the same continuum. And what we're looking for in companies, if I may be so bold as to say, is something that is breaking the rules and doing something, as you said, entirely different. How often do you hear two similes, metaphors I hate are like so-and-so on steroids? I can't stand that. And also it's like Airbnb for. Now, the only really successful
example earlier today to describe a company.
Is it a successful company?
It is.
Do you think it's going to, is it good? Is it successful long-term? Do you think it's going to be like?
We actually used that in our last podcast to describe the render network.
Airbnb for, I guess I'll give you that, but but you're talking about something conceptual.
I'm not
versus physical.
Who's actually in a business where they're doing what Airbnb is doing, only something else.
That's kind of like saying there was never outsourcing or renting until there was Airbnb. So
Right.
you're talking about but we've seen Airbnb for cars, for swimming pools. I found that Airbnb for Airbnb seems to work pretty well. But everything else, whether it's been office space or some other physical product, I'm not saying it's been a total failure, but it hasn't been what Airbnb has been.
Right.
And so we're looking for what successful investors should be looking for, especially if they're in the private stage where you have to have these home run hitters. I mean, beyond a home run, you're looking for a 50 bagger. You need something that is going to be
You might be
paradigm
saying
shifting.
you might be looking for something like Airbnb that took an existing business and so completely upended it into a different model. That's very innovative. And
A
we
meta Airbnb, not necessarily just like something that's renting something to something else.
right,
So,
right.
Yeah.
It's. I think that's a good point because you can, and that's one of the things we look for. Companies where it's not like what they're doing is they're in a space that's with the Salesforce model, enterprise database, but in the cloud and using a SaaS model, and so.
For the record, whenever we're talking about the render network, I just always talk about, and maybe this comes with the confidence of ignorance, but I always talk about it's like the Hubble Space Telescope, because they're outsourcing that processing power to these different nodes. So I avoid the Airbnb comparison altogether. That's, just because I'm brilliant.
I just talk about it from the standpoint of renting GPUs.
So, but there you go. That closes the topic on fertile fields of future growth. We got 3 segments in just under 37 minutes. I think that'll be a good week's worth of work. So until next, actually, let me tell you how you can hear us. Remember, if you're listening to this audioly, please go check us out on YouTube and also LinkedIn as well. And I never mentioned that before. The website is taylorfrigon.com. Find information about us and our funds. You can also find us on Instagram, taylorfrigon.invest. So until next week, I'm Doug.
I'm Jerry.
And remember, subscribe, like, smash the bell, whatever they do on YouTube, and we will see you next week.